What if I told you? The world's top traders, the ones who turn thousands into millions, don't predict the market. Don't use secret indicators. And don't even try to be right all the time. Sounds shocking. Then how did they win? In the legendary book Trade Like a Stock Market Wizard, Mark Minervini wrote about greatest stock market traders of all time, people who survived crashes, volatility, panic and still made fortunes. And here's the crazy part. They all have different strategies, different personalities, different systems. But they share the same mindset. In today's video, we're breaking down the powerful lessons from this book. The psychology, discipline, risk management secrets, and the brutal truths about trading that most beginners ignore. If you want to stop gambling, start thinking like a professional, and understand what really separates winners from losers in the stock market, this summary might completely change how you see money. Let's begin with 3 essential points. Point 1, the dream versus reality. Almost everyone enters the stock market with big expectations. Freedom, wealth, a better future. But fast forward a few years. Most everyday investors are left with average returns, unstable results, and quiet disappointment. We've all been conditioned to believe one thing: if you want huge rewards, you must take huge risks. And if it sounds incredible, it's probably a trap. So people settle. But here's what most never discover. Exceptional performance in stocks is possible. And it doesn't require reckless risk-taking. It demands education, patience, skill built over time. This is not a lottery ticket. It's not luck. It's a craft. And like any craft, it takes discipline, repetition, and the willingness to rethink what you thought you knew about investing. Point 2, the real battle isn't the market. You've been told the market is the enemy. That you need the newest system, the smartest algorithm, the latest AI platform. But here's the hard truth. The market isn't your biggest obstacle. Your reactions are. When prices drop, do you panic? When stocks surge, do you chase? When volatility hits, do you abandon your strategy? You can own the most advanced tools in the world. But without emotional control, those tools mean nothing. Your greatest asset isn't software. It's mindset. Because nobody is more responsible for your financial future than you. If you want better results, you must treat trading like a real business. Serious, structured, strategic. Point 3, the professional approach. At its core, long-term success in stocks is simple: your winners must outweigh your losers. Not every trade will work. But over time, your average gain must exceed your average loss. That's the formula. Buy companies showing real strength. Sell at higher levels. Repeat consistently. But here's where most investors sabotage themselves: they try to master every style at once. Growth investing, value investing, day trading, long-term holding. That's like trying to be a top heart surgeon, a leading neurologist, a psychiatrist, and a pediatric specialist all at the same time. It doesn't work. When you divide your focus, you dilute your performance. Choose a path. Refine your approach. Execute with discipline. That's how ordinary investors evolve into consistent performers. 3 decades of market refinement, a structured winning approach. After more than 30 years of hands-on market experience, the author didn't rely on theory, he relied on real trades, real cycles, real wins, and real losses. Over time, he refined those lessons into a structured framework for identifying high-potential stocks at precise moments. Because in serious investing, precision matters. It's not just about what you buy. It's about when you buy. And just as importantly, when you sell. For investors in the US and global markets, where volatility and opportunity move fast, having a structured decision-making process is essential. Here are the core elements behind that approach. 1. The power of trend. Nearly every major stock winner in US market history began its massive move while already climbing in a clear upward trend. Big advances rarely start from weakness. They emerge from strength. In many historical cases, the early stages of powerful price runs were visible to disciplined investors who understood trend behavior. The message is simple: strong stocks tend to get stronger. Instead of guessing bottoms, professional investors align themselves with established upward momentum, especially during broader bull markets. 2. Strength in the numbers, fundamentals. Major price runs are rarely random. They are typically fueled by measurable business improvement. Accelerating revenue. Expanding profit margins. Rising earnings. In many of the biggest U.S. stock winners, financial improvement began before the explosive price move became obvious to the public. Wall Street reacts to growth. When companies consistently outperform expectations or show strong forward projections, institutions take notice. And institutional money is what drives sustained price expansion. 3. The trigger event. Behind almost every dramatic stock advance, there's a story. A breakthrough product. A disruptive service. A major industry shift, a structural business transformation. Sometimes the catalyst is visible immediately, other times, it requires deeper research. But explosive moves rarely happen without a reason. Serious investors look for companies with a compelling narrative, something capable of attracting sustained demand. 4. Precision entry. Even the strongest stocks pull back. Even powerful trends offer strategic entry windows. Timing matters. Entering too early can result in unnecessary losses. Entering too late increases risk. In strong market environments, well-timed entries can quickly move into profit territory, creating psychological and financial advantage. Disciplined investors wait for low-risk setups rather than chasing extended moves. 5. Controlled exits. Not every promising stock fulfills its potential. Even the best setups fail. That's why risk control is non-negotiable. Professional investors define their exit levels before entering a trade. Losses are kept small. Profits are protected when momentum weakens. The goal is simple: preserve capital. Protect gains. Stay in the game long enough for probabilities to work in your favor. What this structured approach seeks to identify. This refined stock selection process focuses on companies that demonstrate the potential for positive earnings surprises, upward revisions in analyst expectations, strong institutional accumulation, heavy buying interest, accelerating price movement driven by demand exceeding supply. When buying pressure significantly outweighs selling pressure, prices rise rapidly. Markets move on supply and demand, not opinions. The market isn't random chaos. It rewards preparation. It rewards discipline. It rewards structured thinking. And when you combine strong trends, improving fundamentals, real catalysts, smart timing, and strict risk control, you're no longer gambling. You're operating with intention. Understanding the 4 phases of a stock's life cycle. If you truly want to outperform the market, you must understand one critical truth: stocks move in phases. Not randomly. Not emotionally. But structurally. Let's break it down. Phase 1, the base building period, neglect phase. This is the quiet zone. The stock isn't trending higher. It's not collapsing either. It moves sideways. Back and forth. Up a little. Down a little. 4 months. Sometimes even years. Price typically hovers around its long-term average, such as the 200-day moving average, without any sustained direction. Volume dries up. Interest fades. This phase often follows a prolonged decline. Investors are exhausted. Institutions are quiet. It feels dead. And that's exactly why most people ignore it. But here's the key: your goal is not to buy at the absolute lowest price. Trying to pick the exact bottom is ego-driven and unnecessary. Professional investors don't buy cheap. They buy ready, because true outperformance comes from compounding powerful moves, not sitting through endless sideways action. You wait. You prepare. And you invest only when momentum begins to emerge. Phase 2, the advancing phase, institutional accumulation. This is where serious money is made. In this phase, the stock begins forming higher highs and higher lows, a stair-step climb upward. Momentum builds. Volume expands noticeably on strong up days. When the stock pulls back, volume becomes lighter. That contrast is important. It suggests accumulation, large investors stepping in. Key characteristics during this stage: price stays above its long-term moving average. The long-term average itself begins rising. Short-term averages cross above longer-term ones. Strong rallies occur with heavy volume. Pullbacks happen quietly. By this point, the stock may have already doubled. And yet, it could still be early. If earnings and revenue growth continue accelerating, institutional demand can push the stock much higher. This is the phase you want. Not before it. Not after it. During it. Because this is when strength confirms opportunity. Phase 3, the distribution phase, topping process. Now things start to change. The stock may still move higher, but something feels different. Price swings become wider. More volatile. Less controlled. You'll often see a sharp, high-volume drop, sometimes the biggest decline since the uptrend began. That's not random. That's supply entering the market. Large holders may be reducing positions. The stock may begin crossing below its long-term average. Then bouncing back above it. Then breaking again. The once rising moving average flattens. Then starts to turn downward. Momentum weakens. This is where discipline protects you. Because holding through this phase can erase months, or years, of gains. Phase 4, the decline, capitulation phase. This is the breakdown. The majority of price action now occurs below the long-term average. That average is clearly sloping downward. The stock forms lower highs. Lower lows. A stair-step descent. Rallies are weak, and happen on low volume. Sell-offs are aggressive, and occur on heavy volume. You'll often see the stock hitting 52-week lows. This is not a buy-the-dip environment. This is capital preservation mode. Professionals step aside. They don't argue with trend. They respect it. The strategic takeaway for investors: if your objective is consistent outperformance, you must align with Phase 2. You don't chase bottoms. You don't hold through structural breakdowns. You wait for confirmed upward momentum. Because in the end, big returns don't come from guessing. They come from aligning with strength, managing risk, and respecting the stock's life cycle.